Hello, and welcome to MIT Sloan Alumni Online. Every month, MIT Sloan Alumni Online brings you the latest breaking news, cutting-edge research, groundbreaking ideas, and school updates from MIT Sloan faculty and alumni. Today, we are pleased to have Bob Pozen joining us to discuss a very timely and important issue, what the new Tax Act means for your business. Bob is a senior lecturer here at MIT Sloan and a senior fellow at the Brookings Institution. In 2012, he won acclaim for a popular book showing professionals how to get more done at work, titled Extreme Productivity, Boost Your Results, Reduce Your Hours. During his distinguished career, Bob has been active in business, government, and academia. Bob is the executive chairman of MFS Investment Management. And prior to joining MFS, he was vice chairman of Fidelity Investments and president of Fidelity Management and Research Company. Bob served on President Bush's Commission to Strengthen Social Security, where he developed a progressive plan to make the system solvent. He has also served as Secretary of Economic Affairs for Massachusetts Governor Mitt Romney and as chairman of the SEC's Committee to Improve Financial Reporting. Bob is currently an independent director of Medtronic, Nielsen, and AMC, a subsidiary of the World Bank. He serves as chairman of the board of the Tax Policy Center and is on the advisory board of Perella Weinberg Partners. Bob frequently writes articles for the Financial Times, the New York Times, the Wall Street Journal, and the Harvard Business Review. He has also published a book on the financial crisis titled Too Big to Save: How to Fix the U.S. Financial System. And he has authored a guide for investors entitled The Fund Industry, How Your Money is Managed. Bob, it's great to have you with us here today. Thank you for joining us, and I will now turn it over to you.
Well, thank you very much, Kathy. I appreciate that long introduction, even though you left out my high school basketball career. But I'm sure all the listeners already know about that. So today we're going to look at the business aspects of this Tax Act. It's over 500 pages long with another 500 pages of quote-unquote explanation. So this is a huge change in our tax system. And so we can't cover it all, but we can focus on the business aspects. So let's begin with the most important thing, and that is that this act will lower the corporate rate from 35% to 21%. The U.S. for the last 10 years has been a real outlier among advanced industrial countries. They are members of something called the OECD, where the average corporate tax rate is 24%. So we've gone from probably the highest rate to slightly below average. Just to give you a sense, UK is at about 20% and France is about 28%. At the same time, Congress repealed the corporate AMT. This used to be 20%, and if Congress had not done this, then the effective rate of many companies would have been subjected to this AMT. So that's a second really good thing. So these are the most important things and are very, very significant. Now, the other thing that's significant is there was a debate about whether or not reducing the corporate rate should be linked to some sort of limitation on how the extra after-tax profits were used, but these did not make it into the tax bill. So there's no limit on the increase that corporations can have in dividends or share buybacks with their new after-tax income. On the other hand, the Act took the approach of encouraging investment, and that is one of the key rationales for the Act. There will be immediate expensing of capital expenditures from 2018 through the end of 2022. So that's a big advantage rather than having to amortize those capital expenditures over the useful life of equipment or plant you'll get it all up front. This phases out from 2023 on, so it's really important that people use it in the next few years. But there have been lots of surveys among CEOs about how much they're going to increase their capital investment. That's still very much up in the air, but I think Congress at least is looking to the corporate community to use a substantial part of these new after-tax profits to invest in the U.S. Now, like everything in the world, there are some negatives, and there are some negatives here because Congress made an effort to try to keep the cost of this tax bill to $1.5 trillion over 10 years. That's the deficit that's projected to be created by the New Tax Act by the Joint Tax Committee, which is a nonpartisan committee. Probably the most important negative is a new interest deduction, which is limited to 30% of various measures of cash flow. In my view, this is a step in the right direction. Before this act, the tax code was very heavily biased in favor of financing projects with debt rather than equity. In an optimal world, we wouldn't want to have tax driving that decision. We'd want that decision to be driven by the economics. In addition, having such a generous deduction for debt and not for equity encouraged companies to leverage up, and that, as we saw in the financial crisis, was not a particularly good thing. Second thing is there is going to be, for the first time in a long time, amortization of research expenditures. This means that you won't be able to expense them in the first year, but you'll have to spread them out. This begins, however, in 2021, so there's a few years of grace here. And very importantly, the R&D tax credit is retained. That's one of the most important credits for business and clearly is designed to encourage companies to invest in more in the future in their R&D. The third negative in the act is there is a limitation now on deductions for NOLs. Those are net operating losses. There's nothing that happens for net operating losses going backwards, but for all the NOLs after 2017, the companies will be able to only deduct 80% of the losses, and those NOLs can be carried forward, meaning they can be used in future years if you can't use them all in the first year, but they can no longer be carried backward, which many companies did after the financial crisis. So these are three negatives, but I think, fairly speaking, they're quite modest compared to the positives we just looked at. Now, if we focus on specific industries, we can see that some of them did a lot better than others. Let me look at this list that's on your slide from the bottom up. So number 4 reduces orphan drug tax credit from 50% to 25%. So this is obviously a negative for the drug industry, but this is a small class of drugs, ones which are designed to cure diseases that have a relatively small number of patients in the U.S. So it's not a good thing for the drug industry, but it's not the end of the world. Number 3, these miscellaneous deductions are important to the investment management industry because these are the deductions that allow investors to deduct their investment management fees and other expenses. So we're suspending that from 2018 to 2025. So that's a negative for the investment management industry because now you won't be able to deduct those fees and expenses. I should note, as a former executive in the mutual fund industry, that that's not going to affect mutual funds because their expenses are taken care of in the calculations of net income. They're done at the fund level and not at the shareholder level. Number 2 is a very controversial area of carried interest. this is the way we tax the incentive fees that are prevalent for hedge funds and private equity funds. There's been a lot of argument that they should be taxed as ordinary income rather than capital gains, but capital gains treatment was retained as long as the partnership interests, which represent these incentive fees, are held for 3 years. So the hedge funds and the private equity funds came out pretty well. This is just a small constraint on their ability to get capital gains treatment rather than ordinary income treatment. Finally, we have the real estate industry, and perhaps not surprisingly, because our president comes from the real estate industry, this industry clearly did the best of all industries. It's exempt from the 30% limit on interest deductions that we just talked about, and while there are a variety of constraints on what are called like-kind exchanges, they're still alive and well for real property. In addition, real estate deals are usually organized as partnerships, so the partners can take the 20% deduction against income that is now built into the law, and we'll talk about that right now so you can see the other advantage that real estate has and the more general favorable treatment that was given to pass-throughs. Now, let's go to the next slide. And what are pass-throughs? Pass-throughs are broadly defined by the Tax Act to include sole proprietorships, partnerships, both limited and general, limited liability companies, these are sometimes called LLCs, and subchapter S corporations. So all of them are eligible for this 20% deduction because they are pass-throughs. Now remember, pass-throughs are not taxed at the entity level, they're only taxed at the individual level. So they did not get the benefit from the lower tax rate going for corporations from 35 to 21%. They felt strongly that they needed to get a better deal also, and they did, as we'll see. A second definition is qualified business income. This is complicated, and quite frankly, the whole pass-through set of provisions is extremely complex, and I can only give you what we know now. We're clearly going to have to explore this more as people fully digest the 500 pages in the Tax Act, and hopefully we'll get some guidance from the IRS. So generally, qualified business income includes all income from pass-throughs plus REIT income other than capital gains and plus income from publicly traded partnerships. So this is another aspect of real estate that got a special deal. But the pass-through, the qualified business income that we'll see is going to get the 20% deduction does not include capital gains, dividends, and investment interest that comes from partnerships, and it also does not include reasonable compensation for executives of S corporations and guaranteed payments to the active partners who run partnerships. So those are important exceptions. The other really important exception is how the Act treats service firms. Basically, the Act is geared to try to stop service firms from getting the 20% limitation, except for relatively lower income employees and partners. So how are service firms defined? There's a general definition which says if the principal asset is the reputation or skill of the employees or partners, and there are specific specified services. They're sometimes called bad services because they are automatically not eligible for the 20% limit. Those include firms that provide services in healthcare, in law, in consulting, in athletics, and basically all types of financial services. At the last moment, architectural and engineering firms were taken out of this list of bad services, and I'll leave it to you to explain to me why architects and engineers are should be treated differently from the point of tax law from consultants and lawyers. I'm sure there are the arguments, but I'm not sure that they're very strong. So now let's get to, once we understand this, now let's get to the meat of the matter. There is a new 20% deduction for qualified business income that's distributed every year by every pass-through to their owners. This effectively reduces the new top rate on such income to 29.6%. That's basically, how do you get there? You start with a new top rate of 37%, and you take 80% of that, and that's how you get to 29.6%. However, the Act is geared to distinguish very markedly between people who are below certain income thresholds and people who are above them. These income thresholds were established fairly arbitrarily at $157,500 for individuals and $315,000 for couples, that is, joint taxpayers. So here's how it works. Over these income levels, the 20% deduction is always limited by the greater of 50% of W-2 wages or 25% of W-2 wages plus the 2.5% of tangible capital cost. So these wages are determined at the partnership level, and each partner gets an allocable share. The rationale here is we want to encourage partnerships to hire more people and to invest more capital. That's where the alternative comes from. So that always applies if you're above these income thresholds. Moreover, if you're in one of these quote-unquote bad services, firms performing these specified services, the 20% deduction is rapidly phased out over these income levels. So you don't get the 20% deduction at all. You don't have to go through the W-2 calculation because you're not eligible at all. Let me try to illustrate this very complex set of rules with a few simple examples. Let's take an architectural firm where there are two single guys who are working at the firm. One is an employee who receives $250,000 in salary. That person, that guy, will not get the 20% deduction because he is not a partner. He's an employee. All of his income will be W-2 income. Now, compare that to a second guy in the same firm who gets $250,000, but he's a partner of the firm. Then he will get the 20% deduction because he is an owner of the firm. Now, remember what I said. Architecture is not a bad service. It's not in the list of services that we talked about. So there's no phase out. Doesn't matter what the income level is, but this 20% deduction will be subject to the wage limit, and that will be 50% of the allocable share of W-2 wages of the architectural firm that are allocated to this partner. That's a pretty complicated calculation, but I think you can see the principle. Now, let's compare this to a university professor, something close to my heart. Let's assume there's a single lady who's a professor, and as an employee of the university, she earns $100,000, plus she's a very smart person, so she gets another $50,000 in consulting. The $100,000 will obviously be taxed on a W-2 with no 20% deduction. She is an employee of the university. But The $50,000 that she gets for consulting, she's getting as a sole proprietor, and she is under the income limit of $157,000 in total. So that means she can get the 20% deduction. And since she's under the income limit, she doesn't have to worry about either the bad services or the W-2 limit. Now, suppose this same lady professor earns $100,000 from the university, but she has a really good year in consulting, and she makes $200,000 in consulting that year. Well, her $100,000 from the university is still taxed on her W-2 with no 20% deduction, but she cannot get the 20% deduction on the $200,000 in consulting. Consulting is one of the listed so-called bad services, and she is substantially over the income threshold of $157,000. So this will be disallowed. The 20% deduction will be phased out and disallowed for her. So I hope these simple examples give you a sense of partly the complexity of these and how, in a somewhat arbitrary manner, we treat different people differently. But the main message is this: if you're under the $157,000 income threshold as an individual, or $315,000 for couple, then you pretty much can take this 20% deduction if you are a partner or you are a shareholder of an S corporation, a shareholder of a limited liability company, or something like that. But if you are over those income thresholds, you will, in all cases, be subject to this complex limitation of 50% of allocable W-2 wages, those W-2 wages of the partnership that are allocated to you. And if you are in one of the so-called specified bad services, then you will essentially lose this 20% deduction if you are significantly above those income levels. At those income levels, they will start to phase out and they will move to nothing. So that's a significant distinction, all based on these income thresholds. Now, the last thing I want to talk about is the international system, because that is really one of the most significant changes here in the Tax Act. We for many years have been under what is called a worldwide system, where most of the profits of the U.S. corporations throughout that are made in all foreign countries are taxed by the U.S. But the caveat is only if and when they are repatriated to the U.S. So historically, rather than pay the 35% tax if these profits were repatriated, multinationals have tended to hold their foreign profits abroad and not get this 35% tax. As a result, we have over $2.5 trillion in foreign profits that's held abroad, and some people think that the number may be higher. Now, what this act does is move from a worldwide system to a territorial system. That's the one that many countries, industrialized countries, have. Under that system, the general rule is that profits of U.S. corporations will be taxed only in the country where the profits were earned. Now, this raises some very important questions. Some people would argue a territorial system gives U.S. companies a lot of incentive to move jobs and facilities to low-tax jurisdictions. Two good examples: tax havens like Bermuda have no corporate tax, so we see a lot of intellectual property parked in Bermuda, and countries like Switzerland and Singapore are very receptive to go way out of their way to attract facilities and offer them tax rates less than 10%. Now, The Tax Act recognizes this, and Congress established a very complex minimum tax, which goes up to 13.125% on foreign profits. It's not always quite that high, but that's a good number to start with. So if a U.S. firm paid 8% on its foreign profits, it would automatically owe the U.S. the difference between 13.125% and 8%, which is 5.125%. So the notion here is this will deter U.S. corporations from moving jobs and facilities abroad by going to very low tax jurisdictions, that is, jurisdictions with less than 13% tax rates. However, this is a very poorly designed system. I and other people wrote articles explaining why it was so poorly designed, but Congress in its wisdom still chose to adopt it. One of the problems is that it approaches this question on an aggregate basis rather than a country-by-country basis. So think of it this way. Suppose half of a multinational's income was in Japan, France, and Germany, where the average rate of that half of the income was 27%. They could put the other half in zero-rate tax havens, and their average aggregate rate would be 13.5%, and therefore they would not pay the minimum tax. That's why people like me suggested we ought to have this 13% rate apply on a country-by-country basis. By the way, Ireland is 12.5%, so they're more or less right at the level of the minimum tax rate. The second thing that's even more difficult to explain about the way this minimum tax is calculated is that Congress decided that before we get to what a U.S. firm's foreign profits are, we subtract what are called routine profits. And routine profits are arbitrarily defined as an assumed 10% return on a U.S. firm's tangible assets abroad. So let's take a simple example to illustrate this. Supposing you had a U.S. company that had $100 million in foreign profits, and it made this on $300 million in tangible assets abroad. Now, you would think that if it had taxes of, say, $9.5 million, that would clearly come within the minimum tax, because you would have $9.5 million of taxes relative to $100 million in profits. So that would be 9.5%, and that's clearly below the 13%. However, if we apply this subtraction for routine profits, we can see that the $100 million will be reduced by 30, which is 10% of 300, so that the $100 million will come down to 70 million. And therefore, if we look at the so-called adjusted foreign profits, we will see that there's 9.5 million in foreign taxes that are paid over adjusted foreign profits of 70, and that leads to a tax rate of 13.5%. So the numbers are not so important, but the impact is, if we allow a subtraction for routine profits, it will often be the case that the taxes paid relative to the adjusted profits after the subtraction for routine profits will be will be higher than 13%, and therefore the minimum tax will not apply. Now, the last part of the minimum tax, the foreign tax regime, is what happens to these foreign taxes that were paid abroad, that were held abroad in the past. Here, this is a big revenue raiser, so there will be a tax of 15.5% on these foreign profits held abroad that are in a cash or cash equivalent position, and 8% on the profits that are held in relatively illiquid assets. But the good news is once these taxes are paid, these foreign profits can be brought back to the U.S. without any more taxes. And I think a lot of it will, because companies are going to have to pay this repatriation tax regardless of whether they actually bring it back. So they'll have an incentive to bring it back because they're going to have to pay the tax anyway. And this is a lot of money, $2.7 trillion. So that even half of it, $1.3 trillion or something like that, came back to the U.S. to be invested. That'd be a great thing for the U.S. economy. I want to end here on the last slide by just saying, look at the time schedule of this whole act. Under Senate rules, a tax act, in order to be passed by 51 votes and not 60 votes, has to follow the budget reconciliation rules. Those rules require that the act be revenue neutral starting 10 years after the legislation passed. So therefore, lots of things in this act end in 2025. I've listed some of them, and they're really important, including the 20% deduction for pass-throughs and the doubling of a state tax exemption, and most importantly, the reduction in individual rates ends in 2025. By contrast, the reduction in the corporate tax rate and the repeal of the corporate AMT are so-called permanent, but there's really nothing that's permanent here. We'll have a new election, new president, new election, and possibly a new president in 2021. So that's a chance to change the tax laws, especially if the Senate becomes Democratic, then they could pass the legislation by 51 votes. And in any event, after the 2024 presidential election, there are so many things that expire that we can expect that Congress will have to deal with the tax code again. So the good news for business is there's something like 7 or 8 years in which it's going to enjoy a lower tax rate and repeal the corporate AMT. And in the next 4 or 5 years, business will also enjoy immediate expensing of capital expenditures. After that, all bets are off, and we're back into the political soup where it's hard to predict what's going to happen. So I'm going to stop there and take questions and turn it over to Kathy.
Great. Thank you so much, Bob, for helping us understand the impact of this new tax act and the complexities. As a reminder to our participants, please type in your questions in the Q&A box on the right side of your screen. Take a moment to make sure that you've selected all panelists before submitting your question. And while you're doing that, I'd like to take a moment to tell you about an upcoming program. On Wednesday, January 24th, Professor Doug Reddy will join us for our next MIT Sloan Alumni Online program. Professor Reddy will be speaking about the top team's job in building game-changing organizations. You can register on the MIT Sloan Alumni Online website, where you will also find links to previously recorded sessions, or you can stay tuned for future communications from our team with details about upcoming sessions. So now let's move on to questions. We would like to start today's Q&A session with some spotlight questions that were submitted during the registration process. And our first question on the screen is, what is the likely impact of the new tax act on dividends to shareholders?
Well, this is a good question, and it's not clear what the answer is. There will be a substantial increase in after-tax profits. And the question, a really important question for the economy and, quite frankly, for the credibility of corporate America, is how much of this money will go back to shareholders, either as dividends or share buybacks, and how much of this will go into new capital investment in plants and research in the U.S. Congress expects a substantial portion to go into new investments in the U.S. economy. And if most of the money goes back to shareholders, either as dividends or as share repurchases, that will really weigh heavily on Congress when this tax act comes back up for consideration, which will happen at least in 2025 and most likely sooner.
Great, thank you. Our next question is, do you anticipate that companies will change their capital structures because of the new interest limitations?
Yes, I would think that companies that are highly leveraged now, that have a lot of debt relative to equity, will move to change their capital structures because they may very likely be unable to deduct interest. Now, that if you can't deduct it all within the 30% in the first year, you can then carry it over to the next year. But then if you have more debt in the second year, you're still going to have trouble doing this. So I would expect that companies will move somewhat in their capital structures to preferred stock. And I think this will be a chance for Wall Street to show its creativity to come up with new types of preferred that tend to operate more or less like debt securities, but are technically preferred stock for purposes of the act, of the new tax act. So I think we will see some change, and the most likely change is a move toward something that resembles preferred.
Great, thank you. Our last spotlight question is, will deleting the exemption for stock options from the deduction limits for corporations reduce executive compensation?
Well, this is something I did not mention in the slides, but is important, and that is there is a section of the tax code, 162M, which says that companies cannot deduct more than $1 million for the compensation of the top 4 or 5 executives, subject to a whole series of caveats. There used to be an exemption for stock options from this limitation, but that was taken away in this new law. However, I doubt whether it's going to make a real big difference in terms of reducing executive comp. Companies already pay their executives more than $1 million and just don't take the deduction that's above that, and I think that's going to happen here. The history of these attempts by Congress to limit executive comp to the tax code shows that these tax code provisions are pretty ineffective at reducing executive comp. So I think that this one will be in the same category.
Okay, thank you. So now let's move on to some live questions from our viewers. The first one is, how are S corporations and LLCs treated under the new act?
Well, they're both considered pass-throughs, and so their owners are eligible for the 20% limitation. But there are some technical differences that are important. S corporations are corporations in corporate form, although they're partnerships for tax forms. And the way the law works is the executives of S corporations, what they get in terms of compensation would not be considered qualified business income. So if you have somebody who is president of an S corp and let's assume owns 5% of the S corp stock, to the extent that they get distributions as a 5% owner, they will be allowed to take the 20% deductions. But to the extent they get reasonable salary as a president, that will not be allowed. You will not be allowed to take the 20% deduction against that. For partnerships, LLCs are considered partnerships, and therefore most of the distributions will be eligible for the 20% deduction, subject to what I've talked about before, when the income of the partners exceeds a certain level. But again, there's a little glitch, and that is if there are guaranteed payments to partners, then those payments are not eligible for the 20% deduction. So I think to the extent we have guaranteed payments, they're likely to drop the guarantee.
Okay. Our next question is, if I run a consulting firm that also sells products, how can I structure my current S Corp in the new world given the pass-through rule changes?
Well, I'm not in the position of giving tax advice to anyone, so I just want to be clear about that. But in general, you might consider splitting your S Corp into two different S Corps, one of which was involved with consulting, where anyone who gets income from that above the income thresholds will probably not be able to take the 20% deduction. But if you sell products and service other products, then they will be. So that would be, at first glance, something that ought to be seriously considered.
Okay, thank you. What are some of the potential impacts on corporations in high SALT states?
Well, high SALT states means states in which there is a large deduction for, large local and state income taxes. SALT means state and local taxes. So the state and local tax limitation, which is in the Tax Act, is limited to $10,000 per taxpayer. And so this $10,000 can be in the form of state or local income tax, sales tax, or property tax. So corporations are not directly affected by that, in the sense that companies will still be able to deduct their property taxes and income taxes as expenses, as regular expenses. These limitations to $10,000 are mainly limitations that would hit individuals. Now, of course, companies have to be worried about their executives and their individuals, so indirectly it will have an impact. But the $10,000 limitation is a limitation that applies to individuals and not to C Corps.
Okay. This question is, what income comprises the limit of $315,000 for pass-throughs? AGI or just income from the pass-through entity?
The $315,000 is total income, your whole AGI from any source. So it's not just the income that comes from your pass-throughs. So the idea was we would discourage high-income taxpayers who are in these service industries from converting from employees to LLCs or partnerships. So it's based on your whole income, not just your income from the partnership.
Okay. I have another question. I'm concerned about expanding employment and increasing income tax payments and collections. So what is the likelihood of this happening in light of the lower corporate tax rate?
Well, corporate taxes only provide a relatively small portion of the revenue of the government. It used to be much bigger, but corporate taxes are now down below 20% of the revenue that the government has. So in that sense, it has a smaller effect. But if you look at the $1.5 trillion deficit created by this act, about $1 trillion of it is basically attributable to a lower corporate tax rate. And so we can expect over 10 years that the government will collect $1 trillion, roughly $1 trillion less in corporate taxes than it would have if corporate taxes had stayed at 35% rather than 21%. But there are two big caveats. One is there are a lot of people who would argue that the lower tax rate for corporations will bring about more profits, will bring about more company investments, and therefore will have a larger pie. That clearly will happen to some degree. The question is how much. If it happens a lot, then the $1 trillion might come down to something like $500 billion, and there are many people who feel that's a more realistic number. On the other hand, this very complex set of provisions relating to partnerships and LLCs and Subchapter S, most people who are tax experts feel this is a landmine and is very likely to lead to lots of games playing by a lot of people and therefore less revenue for the government. And at the same time, the IRS is under pressure. It's getting less money. So its ability to find these games and to go after them is less and less effective. So I think that that's a big soft spot. It may turn out that lots of people who maybe Congress didn't intend to get the 20% limit are going to figure out very clever ways to get the limit, to get that, 20% deduction.
Okay. Would you expect that the repatriated overseas cash will be reinvested in plant and equipment in the U.S. or paid out to shareholders?
Well, the answer is clearly both will happen. The question is, what is the proportion? Can get paid to shareholders either in dividends or share buybacks. I myself am very concerned that we've had a huge, very high level of share buybacks in the last 5 or 10 years, and I think that it's not a great thing for the economy. Dividends, I think, are actually more useful, but corporate share buybacks also occur sometimes because companies borrow money and then they buy back their shares. So that's tended to go down a little recently, but clearly there's a big pot of money here, and some of it will go back to shareholders, and that's perfectly legitimate. But if 90% goes back to shareholders and only 10% gets invested, there'll be lots of people in Congress and in other places who will think that that's not a good thing. And that's especially true in the next 4 or 5 years when companies are incented to make capital expenditures in the U.S. by immediate expensing of these investments. So the answer is we don't know, but hopefully we'll have a balanced approach, that there'll be a substantial portion that will go to capital investment, and most, if not all of it, will not go to shareholders. There'll be a reasonable balance between these.
Okay, I have a question that is a little bit more specific on something. What are some of the most material impacts to corporations operating in Puerto Rico?
Well, Puerto Rico tends to be treated like a foreign country for tax purposes, and that status of Puerto Rico was generally kept under this new act. But there are a number of technical changes that were made that are relevant to Puerto Rico, and I really don't feel I'm not a Puerto Rico expert, so therefore I really don't feel comfortable to try to explicate them. The good news for Puerto Rico is that they generally retained their special tax status, and that's a positive thing. On the other hand, I could say this: to the extent that you have a much lower rate in the U.S., then the relative attractiveness of moving facilities to Puerto Rico is diminished. So if Puerto Rico is willing to offer you, say, 8% or 10%, that's obviously going to be much more attractive if you're paying 35% in the U.S. versus 21%. So I think in that sense, Puerto Rico will become less attractive than it has been in the past as a magnet for U.S. corporate facilities.
Thank you. I think we have time for one more question. Do you think it would limit M&A activities because constraint on benefits could be achieved through leverage?
Well, I think to the contrary, this, to the extent that we've had M&A activity by private equity firms, many of those M&As have been financed heavily by debt, and that will be now quite constrained by this 30% limit. And in the first few years, the limit is a more generous one, but then it becomes a little more restrictive. So those highly leveraged deals that were financed by private equity, those are going to be a thing of the past. And so therefore, we will have less M&A that is built on highly leveraged transactions. I think that's a good thing because when you have really highly leveraged private equity transactions, they tend to be very fragile, and we've had a number of significant bankruptcies. But I think private equity will adjust, and they will figure out a way to have some type of preferred stock as well as some debt, and will definitely continue to have mergers and acquisitions that are financed by private equity. But there'll be fewer transactions probably, and less leverage transactions, and so that slack may be picked up by businesses that have more capital and aren't where the transaction doesn't require that high leverage. But all in all, I would expect that the limits on leverage here, the limits on ability to deduct interest, will have a modest dampening on the M&A scene in the United States.
Great, thank you so much. Well, Bob, thank you again for joining us today. I also want to thank all of our Sloan alumni and friends for joining us. To keep this conversation going over social media, please use the hashtag SloanEChat. We hope you will be able to join us for future MIT Sloan Alumni online events, which are made possible in part by the Sloan Annual Fund. As today's event comes to a close, please take a moment to complete the brief survey that will automatically pop up on your screen. Thank you for joining MIT Sloan Alumni Online.